Stocks fall on a disappointing start to the earnings season. Financials and industrials are the big drags, while metals remain a bright spot. Mid-caps relatively fare better.
Axis Bank reports a sharp jump in provisions in a big surprise for investors, while the technical provisions against secured assets strengthens the book for the future. An uptick in regular credit costs as well, that is something that is dragging the stock.
Wipro's Q1 performance is largely in line and nothing to crow about, but some big deal wins offer some optimism for the future. The stock books up.
And Clean Science Tech skids after it trims margin guidance and points to likely stake sale by promoters. But Nuvoco Vistas climbs on a sharp jump in operating profits and significant reduction in debt.
Hello and welcome to Halftime Report, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra. With me is Vinny Motiwala. Well, it's turning out to be a session which is weak at this point in time. So we have the Nifty, which is down around 0.6% as we speak. We have the Bank Nifty, which is under pressure. And really the star point of today's trading session, considering that the street is disappointed with what they saw on Axis. Axis, that stock is down around 4% at this point. Top loser on the Nifty as we speak. We do have a lot of earnings to reckon with over the next 2 odd days. In fact, Saturday is going to be quite important in terms of numbers. We do have the likes of HDFC Bank, which will be releasing numbers tomorrow. So that'll be something to watch out for, along with ICICI, Yes Bank. A couple of those stocks would be in focus. We have Reliance Industries today, so that would be the other big one to watch out for. Overall, pressured day for the markets, led by the banking stocks. Hi,
Absolutely. Hi, Ekta. Good afternoon. And banking, that's what is dragging the market as well. All these private banks today with the Axis Bank are falling in trade. We're waiting out for their numbers tomorrow as well, like Ekta was mentioning. Today, in terms of sectors also, most of the sectors are trading in the red. We have some bit of a bright spot today coming in from the IT side. So Nifty IT is holding on to a very marginal gain. We have metals as well as media among the other sectors, which are holding on to some bit of a gain in today's trading session. A lot of movers and coming in on the back of numbers as well. Tata Com, Nuvoco Vista, Wipro, Suntech Realty are some of the movers on the back of earnings on the positive side, while on the flip side, Shoppers Stop, Route Mobile, CEAT are the other ones which are falling in trade on the back of news flows as well as earnings. So that's what we are keeping an eye out on. Banks are going to be the key focus as well. But South Indian Bank, that is the bank, and that is the first management that we'll be talking to on the show as well today. The bank's net interest margins have declined 18 basis point quarter-on-quarter basis. Also, in terms of provisions, that have risen by 111.8%. This is on a year-on-year basis again. Now, talk to us about their earnings. What are we expecting from the management going forward? What should we be watching out from the bank going forward? We have PR Sheshadri, who's the Managing Director and CEO at South Indian Bank, joining in with us to talk to us about just that. Mr. Sheshadri, thank you so much. Good afternoon. Let's start by talking a bit in terms of the numbers for the company, right? So what I want to start by talking about is in terms of NIMs that we're mentioning right now as well, that 18 basis point quarter-on-quarter basis decline is what we're seeing. Now, how much of the rate cut is passed during this quarter, and by when are you expecting your NIMs to start stabilizing now?
Thank you very much for having me on the show. We are actually reasonably pleased with the quarter that just went by. Our revenues grew 13%. Our expenses were flat. Pre-provisioning operating profit was up 32% and profits are up 10%. We were aided by treasury income that offset some of the NIM pressure that you mentioned. I think we are not alone in having problems as far as NIMs are concerned. This is essentially because our assets are repricing faster than our deposits. And the pressure is not by all means over. I think it will continue into the second quarter. And if RBI were to reduce repo rates again, it perhaps would carry on into the third quarter as well. We are trying to address that by changing our asset mix. But that does take a little bit of time. We are underrepresented in retail and MSME, and these are areas where we now have a reasonable outlook for growth. More importantly, our asset structure has changed. Our slippage for the quarter was only 20 basis points, which puts us amongst the best in the street when it comes to portfolio quality. And therefore, it gives us a little bit of leeway in terms of the risks that we can run as we go forward. And consequently, we think that this is a year of growth for South Indian Bank. And we are hoping that growth will be significantly higher than that street.
Mr. Seshadri, you're mentioning, right, like your NIMs may see some bit of a pressure coming in Q2 as well, right? Last time in Q4, you couldn't give us a guidance. It was too early to talk about anything. But then what could we be expecting in terms of NIMs? Any near-term guidance that we're watching out for, as well as an FY26 guidance, if you could give us that as well?
Our 40% of our book is linked to external benchmarks. And that has dropped by 100 basis points. So if you do a simple math, which is multiply 40% by 100 basis points, you get a number. The outcome for us is lower than what the number is showing. It should ideally, you should say it's about a 40 basis points impact that you would expect. But we are taking action to stop that from happening. So we've had 18 basis points flow through, but there is a little bit more that is likely to happen as we go forward. The exact number is very hard to predict because, there are so many moving parts. But the point that needs to be made is the fact that the NIM pressure is by no means over as we go forward.
Okay. All right. Mr. Seshadri, I heard you mention that asset quality has actually been one of the best in class. Just tell us what the absolute amount was in terms of slippages this quarter.
It was about 189 crores.
Okay.
So it was very low. It's 20 basis points in total. We provided in excess because we have a historical book which had high gross NPA. And our aim was to ensure that the gross and net NPAs are brought in line with what the street currently has. So that's the reason why there is additional provisions that have been made during this quarter.
Okay. Give us a sense in terms of, it doesn't look like you've had maybe too much of a problem in most segments, but the personal segment showed majority of the problem in terms of slippages. So if you could just provide some color in terms of what's taking place in the personal segment, and if you could give us an idea in terms of guidance on slippages as well. Are you expecting it to probably be in this range of 180 odd crores in the next couple of quarters? Do you expect it to be lesser? Do you expect it to be more?
On the personal segment, we have a small credit card stroke personal loan book. Majority of the losses are coming from that. On aggregate, the loss rate on both of these put together is in the neighborhood of about 3 to 4% annualized. And given the spreads that we have on these products, they're very, very profitable. So we're not very worried about that. The underlying portfolio, to the best of our knowledge, is sound, and we do not expect the loss rates to materially change as we go forward. So we expect slippages to be in the same ballpark as we go into the next quarter as well.
Right, Mr. Seshadri, you made a point earlier as well that, treasury income, that was something that was supporting the overall profitability and operating profits for the company this time in this quarter. Now, this is something that is a positive there, but will this net interest income actually sustain going forward? What are we watching out for?
That is the area of concern for us as well. And that is why we are working doubly hard to change the portfolio mix. This is something that has been occasioned by the change in the external benchmarks. Unfortunately, there is very limited leeway for us in terms of, and so we are trying to do as much as we can to build an alternate structure within the bank to originate higher yielding assets so that the impact of this is minimized. It is a challenging environment for us to work on, and it is something that we are cognizant of and we're addressing.
Okay. Just two questions before we let you go, sir. One was on your gold loan book. It's up just by around 7% year on year. The RBI is now allowed reclassification of agri gold loans as PSL. So is that a segment that you would probably look to incrementally increase in terms of loans? One. And two, just wanted your view in terms of branch addition, because, in FY25, we understand that the branch count declined. So is there any kind of strategy when it comes to branch addition, and why are you holding back?
Okay. With respect to gold, our approximately a fifth of our portfolio is gold, and we are keen to grow this. And we think that as we go through this year, that will become more like 22-23% of our total book. There will, of course, come a point in time where prudence will, have us, not grow that more aggressively. But at this point in time, we intend to grow this reasonably aggressively. With respect to branch rollout, we took an intentional pause. As an institution, we had higher costs, relative to our peers, and we wanted to actually address that so that our profitability could be maintained. So as a consequence, we've had revenues growing at 13% and costs being flat, which is what has helped our pre-provisioning operating profit. And now that as revenues grow, it gives us the flexibility to start adding branches, which we intend to do in our core markets, which is largely peninsular India, Maharashtra, Gujarat, and the National Capital Region.
Okay, Mr. Sheshadri, thank you so much for joining in with us on the show and giving us an understanding of what we could be watching out from the bank going forward as well. Thank you so much for that. But on that note, we'll slip into a very short break, and after the break, we'll get you more on markets and focus on Axis Bank, Wipro, individual stocks, what's happening there as well. Welcome back to Halftime Report on CNBC-TV18. Like you can see today, the favor is more in the terms of declines versus advances, and even on the Nifty, most of the stocks are trading in the red versus what is trading in the green. Some of the names coming in on the IT pack, which are managing to hold on to green. So you have Wipro and Infosys, which is managing to hold on to the green side. And other than that, some bit of these auto names like Tata Motors as well as Bajaj Auto, which are managing to hold on to green, but a lot of action that's happening in terms of moves because of the earnings season as well. So obviously in just the last few minutes as well, what we're seeing a fall coming in is for DP Realty. That's under pressure as well. Clean Sciences, I mentioned before, that's also under pressure. We have Nugent Software that's under pressure because its numbers were reported yesterday. Concall didn't seem to be that exciting. So that is something that we'll watch out for. Root Mobile, Sterling and Wilson, among some of the other names that are in focus and trading on the red side today as well. But the main focus today is going to be banks, because Axis Bank, that reported its numbers. And with Axis Bank falling, we're seeing even HDFC Bank, ICICI Bank, that's not doing anything great in today's trading session. Now, Axis Bank has disappointed in this Q1 FY26. Asset quality, that also saw a deterioration, dragging the profits lower. Gaurav is joining in with us to give us a fine print in terms of what happened in Axis Bank and what a brokerage is saying as well. Gaurav, over to you.
Well, yes, when it comes to Axis Bank, the biggest pain point remained asset quality in first quarter, and let me tell you why. When we talk about net interest margins, they have declined almost by 17 basis points on a quarter-on-quarter basis. Now, Street is expecting 10 to 12 basis points, and the bank has attributed around 13 basis points of fall because of the repricing. But what remained as a negative surprise is provisioning. Now, bank has changed their provisioning norm. They have made it more stringent, and as a result, we saw a sharp rise in credit cost. Provisioning has gone up almost by 800 crores in this quarter itself. When it comes to slippages, now fresh slippages stands at around 800 and 200 crores, which was as low as 5,400 crores if we exclude the technical impact that the bank has reported in this quarter. As a result, credit cost has gone up almost to 1.4%, which was anticipated somewhere in the range of 1%, and slippages have gone up almost to 3%, which was anticipated somewhere in the range of 2%. Now, that was a negative surprise which is driving the stock price right now. This impact was seen on profitability as well. We have seen an impact of around 620 crore rupees on the profitability. As a result, ROAs have gone down almost by 15 basis points, and ROEs also took a hit of of 1.4% when it comes to the technical impact. Now, what management is saying is that in coming quarters, slippages are likely to stay stable. And the reason being that there will be higher recovery, and that is the reason they believe that credit cost is also likely to come down. In FY27, we may see credit cost normalization. On the other front, when it comes to loan book growth, it has grown almost at 8%, and now management believes that they have an ability to increase their loan book higher than the industry. So that is something where we are seeing an optimistic commentary coming up from the management. But overall, in terms of disappointment, in terms of the numbers from provisioning, we are seeing a sharp fall. Axis Bank, as we speak, it is down more than 3%.
Okay, yes, absolutely. Thanks very much for that, Gaurav. So that's Axis. The management in the conference call said that they are confident about growing faster than the industry. Listen in.
So roughly, if you look at what we do is Q1 and Q3 are cyclical. And the way I would request you to think about it is in Q1 and Q3, about 25% or thereabouts of slippages are from the agri portfolio. So you could apply the maths to 5,400 crores, and roughly about 25% or thereabouts would be agri. The percentage would be broadly similar for last year's rupee crore number. The rest of the 75% is coming entirely from the unsecured business. We are very clear in making a call out saying we do not see stress in the secured part of our retail book as on date.
When Rajiv retires in August, as per expectations of RBI, we need to have MD/CEO and 3 EDs. Our NRC is actively looking at who and when we appoint a third person as executive director of the bank. When we're ready to do that, we'll be very happy to do it. But you should expect announcement of ED appointment as Rajiv retires. So that's the answer to one of your questions. Second question, I thought I answered in detail in the response to the first question, which was, yes, credit growth is where it is, but our confidence about what we can do the rest of the year and in the medium term, given where our platform is high. We are expecting to grow faster than the industry. I mean, obviously, that's an expectation, but we are quite driven towards ensuring that we can deliver that output.
Okay, that's on Axis. Wipro has met muted estimates in the first quarter. Revenue contracted 2% on a constant currency basis. Margins also contracted sequentially, but largely in line with estimates. Reema's here with more details with regards to Wipro. Reema.
Thanks so much for that. So as you rightly pointed out, Q1 was in line with muted expectations. But I'm going to see I see some silver linings. For starters, Q2 guidance suggests to an improvement versus Q1, and the deal bookings are very, very strong, up on an average 50% on a sequential basis. But let's get to the numbers first. Now, constant currency revenue growth has declined by 2% quarter on quarter. This is within the company's own guidance. They're guided for -1.5% to -3.5%. So within the guidance, margins have come in at 17.3%. But the Q2 guidance, next quarter's guidance, is at -1% to +1%, which means that if the company achieves the middle point of its guidance, that 0%, it would be an improvement. Even if things deteriorate and the company does, at the lower end of its guidance, -1%, that's still an improvement compared to -2% that they've done in Q1. That said, Q2 is typically a seasonally stronger quarter for Wipro, so generally things do improve for the company. So just to quickly, some more numbers, this -2% would mark the second consecutive quarter of a revenue decline, and we've seen revenue declines across all the large cap peers. So whether it's TCS with a -3.3% decline or an HCL Tech with a -0.8%. So basically, large cap IT companies have reported a revenue drop this time, and it's no different for Wipro. The deal wins have been particularly very, very strong. So the total deal bookings have come in at $4.9 billion, which is an uptick of 24% quarter on quarter, 50% on a year-on-year basis. The company's also signed 16 large deals, which includes 2 mega deals. And if you just look at the pure large deal wins, that is up 50%. So Q1 weak, but Q2 points to an improvement versus Q1. Sequentially, it should be better in Q2, and the deal bookings are very strong. Other numbers like attrition is ticking up very marginally. Headcount is down by a bit, but I think the deal bookings and the quarterly guidance would be the key parameters, the KPIs to track for Wipro.
Absolutely, but we also spoke to the management of the company. Listen into some excerpts of that conversation.
So there is this very strong deal momentum that we have had in quarter one, which we trying to carry to quarter two. Of course, some of these deals will take its own time before we start ramping up. Second half for us will definitely be better than the first half, especially because of the large deal bookings and the pipeline that we have at this point in time. What is very important for us to execute these large deals. And also the pipeline continues to stay strong for us. So that gives us the confidence that H2 will be better than H1.
For those deals to really translate into revenues, it will require upfront investments. There will be pressure on costs. You know that large deals typically come at lower margins, and there will be some pressures that we will have to offset. We will go back to that muscle of operational excellence that we will continue to drive. And those are the puts and takes on margins. We don't guide for margins, but we are happy with our performance in Q1, an 80 basis points improvement. And from there, we will take it.
Okay, on that note, we're going to slip into a very short break. After the break, we'll be joined by Manish Hathiramani from Deen Dayal Investments, who will join us to talk about his trading strategies and on the market on the other side. Welcome back to Halftime Report on CNBC-TV18. And now we have Manish Hathiramani, who is from Deen Dayal Investments, joining in with us to talk about his trading strategies. Manish, good afternoon. Thank you so much for joining in with us. Now, today, obviously, we're seeing a fall coming in for all the markets, and this week has been such, right? While there was some bit of a gain coming in for 1 2 days, but after that, it's more of a consolidation that we're seeing this week. 24,900 as of now is what the Nifty is at approximately. What are the levels we should keep an eye out on now?
Good afternoon to you and to all our viewers. Thank you so much for having me on the show. Well, last week on the same show, when I was discussing with Mangalam, we had discussed that we are in a range. And 25,300 was a good support and the lower end of the range. We broke that and we have tested 25,000 today. So I would be looking at this key level of 25,000 because it's technical and psychological. If we break 25,000 on a closing basis, I feel they're going to get weaker. And the next level to look out for would be 24,650. On the upside, currently 25,300, 25,400 is the resistance.
Okay, so you're expecting the markets to trend lower if in case they do break 25,000. Currently, the Nifty is at 24,941. So let's see where we close in today's trading session. But what do you think is probably going to be the key reason for the weakness? We're seeing it to be banks at this point in time. Do you think that's going to probably break the markets back?
Well, we do see large caps overall slipping downwards. Key support levels in the short term have broken down. It's too soon to say that has the overall trend changed. The answer to that is no. We're talking about short-term pullback, short-term falls. Given that, I'm working with 2 sell calls. The first one is on an ICICI Bank, which is for a target of 1385, stop loss of 1440. After being sideways for a brief period of time, the stock has broken the lower end of the range, which was 1420. The second one is on Apollo Hospitals for a target of 7120, stop loss of 7420. We see a mild pullback after the stock broke the support of 7350. The risk reward being favorable as the stock is still languishing in a short-term downtrend.
Okay, Manish, thank you so much for joining in with us, talking to us about the markets as well as telling us which are the stocks that we should be keeping an eye out on as well. But on that note, we're going to sip into a short break. But as we are sipping into the break, we can see the numbers of IOB at the bottom of your screens as well. Net profit is up 76%, 1,111 crores versus just 633 crores last year. We'll keep an eye out on more internals in terms of the NII. How is the NPA doing as well? That is something we'll watch out for. We'll take you through that after the break. But, on the other side, we also have Manisha Gupta, who's joining in with us with Sachin Jain, Managing Director at World Gold Council. So stay tuned for that conversation.
Welcome back, and joining us on the show now is Sachin Jain. He's a Managing Director at World Gold Council. Sachin, hi, thank you so much for joining in. And the last couple of days or sessions clearly have been quite productive. I'll take it one by one. And the first one is from SEBI, which has released a consultation paper suggesting that the prices that we have on ETFs right now should perhaps be linked to the spot prices in the Indian markets rather than LBMA. How would you react to that?
So first and foremost, Manisha, thanks for having me over. And yes, I think SEBI's issuance is, I think if you take a step back as to why it's come in, is that ETFs are becoming more and more proper, more sort of main stage. And there is a belief that there'll be a phenomenal growth coming in from the ETF, both in the world in terms of the AUMs, but also the interest of the investor, and not just very avid financial investors, but investors on the field, so on the ground, and really Indians and the Indians on the street. So I guess any stipulation from the SEBI's perspective is towards ensuring that there's more transparency, there's more confidence, and there is no gap or a lacuna in between. So as an industry, we welcome it. I think it only sort of refreshes what's happening right now. Can it be done better? And I think it's really a call to a future that'll be much more bigger.
And Sachin, the second one was from IRDAI, and as we know that as of now, the insurance companies are not allowed to invest in commodities. But with the way IRDAI proposal also comes in on how insurance companies may invest or may be allowed to invest in gold ETFs, also does support a lot of conversation that we've had earlier as well. As you said, ETFs really are here to stay, grow, and grow considerably. With the insurance company regulator also looking at that, what's your sense?
I think both regulators, like insurance regulators and also the provident fund regulators in our country today, do not permit any investment on gold. And I think there's been a lot of conversation globally and also in India, where as an investor, what you really bring on the table with some part of diversification gold is make your portfolio healthy. I mean, there could be a lot of debate about this current, when you look at a 20-year history of gold, and there'll be a lot of pushback to saying, if you delete the last 5 years, then perhaps the returns might not be as healthy as equities, which is perhaps a true fact. However, what gold does is a play in terms of liquidity. And when you look at specific zones of pressure in 2008, in COVID times and all, that's when the health of your portfolio dramatically improves. And I think the insurers, the regulators are acknowledging that fact. And I really foresee that it's not about gold getting pushed. It's about Indians' long-term investment via insurance companies and provident fund investors is healthy and is very long-term.
Sachin, I do understand that a lot of work on ETF is being done. I remember my previous conversations with you as well, that there was this conversation about ability to perhaps redeem ETFs going forward in more ways than cash. Have we moved any forward on that?
We have, Nisha, and I think that's been quite extensive work on that area, and thanks for bringing it up again. All the mutual fund suppliers have been quite proactive and giving us all the inputs around it. We've been working with the regulators around it, and the intent would be that we will be running a pilot with some select partners to see the nuts and bolts of it. And we all believe collectively that this will be the fungibility of ETF into the jewelry world will be a very, very good step, very healthy step. One, for usage of ETF, and secondly, more importantly, the awareness of ETF and what can do to an avid consumer.
And how soon do we see this pilot coming in? Is there a timeline that you're working with?
On the corner, Manisha. So I foresee quarter 4, certainly we should be live, is what our earliest estimate would be.
Since we have you with us, Sachin, what's your sense also on the demand? Because the first half gone by does show us a very mixed picture. Of course, the returns are huge, but the kind of investment or the jewelry buying, especially that we have seen, has taken a hit.
So let's talk about what's happening globally and what really happened in the first half of the year. As you said, the gold has performed at 26% return in the first half of the year, which has been historic and has been the best performing asset class, and truly driven by a sort of weakening dollar. We're talking about the geopolitics uncertainties that are happening, but a very robust investor demand and the continued central bank buying. Now, when you look at the next half of the year, there could be perhaps 3 scenarios. One, which we believe perhaps will be the most sort of obvious one, and that we think is a more consensus expectation, where there will be a relatively steady finish of gold to the end, and we believe a 0 to 5% upside with a slightly more stability on the various elements of things that we see. The other aspect could be that if we see a huge volatility and even increased geopolitics risks and uncertainties, even huge trade issues happening, then we could perhaps look at a gold getting to between 10 and 15% increase from here on. And on the third side, if everything normalizes, there's no trade issue, all countries start loving each other, then we think that gold might just get down to about 10 to 12%, which I think is a very bleak possibility. So that's the three scenarios in which what we think might happen. Now, to your point on the jewelry side, I think first 2 quarters, you certainly see a drop in jewelry, but it's important to also keep an eye that an Indian consumer who's buying jewelry is buying from the cash or the disposable money he has on his hands, and that sheer number has gone up. So volume might have come down, but the consumer's interest in how they're buying jewelry and gold has been up quarter by quarter. And what we've seen historically is that when the prices go up, the consumer is waiting for some stability, which I think we are very happy to say it's happened now. And as you get into the second half of the year, if the prices are stable and move up, perhaps in a very sort of stable manner, then I'm a firm belief the Indian consumer is going to come back into the market buying jewelry. And we base that on our recent consumer surveys, where the obsession or the sort of interest on gold and gold jewelry is an all-time high. So, and I also see that industry doing some great work in terms of lightweight pieces, more affordable pieces, more creative pieces, attuned to lifestyle. And you see all of that in play in the second half of the year.
Oh, well, absolutely. The obsession to owning jewelry is actually on a high. Sachin, this last question to you is not as a World Gold Council, but as a personal question, really. What is your sense on where are the prices going? But otherwise, you won't answer this one because, the street really seems to be talking about 3,500 and 3,800 and 4,000 and thereabouts as well.
Well, I think even on a personal level, I don't see anything differently, Manisha. I really think that when you look at the peaks of gold prices that have absorbed a lot of these issues and shocks that are around the corner, some of them have been made a reality. But I think it'd be more stable from where we are upwards. And hence, there will be some sense of normalcy to saying, guys, this is the price. Now, should I consume or not consume it? And I think it certainly simplifies jewelry consumer. But as an investor, I personally, as you said, I have always looked at gold as a very long-term allocation of my portfolio. I'm very tiny portfolio, but very, very small allocation there. And I guess that from that long-term view, I think it's a perfect time.
Okay, all right, Manisha, thanks very much for that. So that's on the entire gold space. And Vinny, you have some incremental information on that gold.
Because it's very interesting because gold ETF, like you were mentioning, right, it's picking up interest. And that is what we saw in July as well. It's back above that 2,000 mark, again. So
it was near record highs. And as Sachin says, and as the news has been, Vinny, that you have SEBI saying that the prices should be more, domestic. You have IRDAI saying that insurance companies can go into that. And as Sachin told us that now that you buy ETFs, you can redeem it into jewelry. I mean, what else do you want?
Nothing more than one could ask for.
India's love affair with gold will never end. All right, Manisha, thanks very much for that. Well, we need to take a short break, but remember to tune into the all-new CNBC-TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C and Global Lens at 8:30 p.m. Welcome back. Well, managed workspace solutions company IndiCube Space's 700 crore IPO will open on the 23rd of July. The IPO comprises of a fresh issue of 650 crores and an OFS of around 50 crores. Our colleague Reema Tendulkar caught up with the top management of the company, began by asking about the IPO itself.
If you look at, we were following the IGAAP accounting standards till 2023. And then in the last 2 years, we have moved to the India's accounting standard. And as per the IGAAP accounting standard for the FY23, we have reported a profit as per the income tax filings that we have done. And in 2024-25, because of the Ind AS accounting standard is where basically we are seeing losses. As you may have seen that our EBITDA margins look very, very promising, like 58% at the overall. Now, obvious question people ask is that from such a high EBITDA, how suddenly you are having losses? The thing is that whatever rental payouts that we do to our landlords, they are all capitalized and they are also treated as a liability from a payment perspective, and those do not factor in the EBITDA. So as a result, you see very, very high EBITDA margins.
So the lease rental is excluded from the EBITDA.
Yes.
It comes in below as
Correct.
line item.
Correct.
Okay.
So that is where you see extremely high EBITDA. Then when you move down, what happens is, since this has been treated as an asset and a liability at the same time, so there is a significant amount of depreciation and interest that is notionally computed as per accounting standard. Now that is way in excess of the actual rents or the actual depreciation that we have on our basically physical assets.
So given the recurring losses under the accounting standards, should investors assume that the company will continue to report losses, statutory losses, or will the company break even at the PAT level?
So if we look at the Ind AS accounting standard for any lease that has been capitalized, initially the impact of depreciation and interest tends to be higher for that, and over a period of time that impact starts reducing. So I think if we factor into that, and as business starts growing, at some stage this will turn.
Let's look at your cash EBIT. Your cash EBIT margin is at 10.8%. Is that the industry standard? And is there headroom to improve this number? And if yes, what would be the levers? Would it be operating scale? Would it be pricing?
So what we see is that if we were to give the past data, definitely we see that this number has improved. We believe that there is a lot of operating leverage that is available. Plus, we have made significant investments into green power. We have commissioned a 20 megawatt solar plant in Karnataka, out of which more than 50% is already operational over there. So we see a significant amount of savings should accrue to us on account of those investments as well.
So now just to understand and to summarize what we've spoken so far, under IGAAP, the company turned profitable in FY23. It's showing a loss purely on account of Ind AS accounting. The correct margins to look at would be the cash EBIT margins, which are at 10.8%, but there is scope for those, there is headroom for those cash EBIT margins to go up. I mean, you all have a fundraise of about 463 crore, which will be used for CAPEX, for increasing the pipeline. So your current AUM is 6.4 million square feet, and the active stock is 6.3 million square feet. Explain to us what this pipeline will look like, the AUM that you will manage, say, once you deploy all the money.
So as you rightly said, the AUM is 8.4. So there's a headroom of 2.1. If you can see from 6.3 million square feet of active stock between 8.4, you have 2.1. And our capex cost is about 1,500 rupees per square feet. So for that, 2 million into 1,500 would amount to almost like average about 300 crores would be going to kind of cover that 2 million square feet. And the balance 150, we have actually kept the buffer for the growth. So that is how the whole 460 crores which you're seeing would be utilized in the capex.
Rishi, your revenues have practically doubled in 2 years. And I think the revenue CAGR is like close to 35%. So you've outpaced the industry. In this period, what was the industry growth rate, and can you continue to outperform?
Yeah, so if you look at the CBRE data, the year that got over, the calendar year 2025, was done at about 100 million square feet of managed office space. This number was about 80 million a year back. And as per their forecast, in next 2 years, this number is likely to go to about 140 million. So the industry has grown and looks likely to grow at a very healthy growth rate, about 20%. And somebody who has a large presence pan-India in about 15 cities, we feel that we will be able to continue to do better than the industry average. And if historical data is any indication, I think that's how it looks like.
What percentage of your FY25 revenues, for instance, come in from global capability centers? And could you provide a segmental breakup of your revenues?
In terms of seats, if I have to go, it's a 63% comes from more than 300 seats. So we are pretty much practically, large customer, long stay customers. So more than 300, I said 63%. Out of that, 44% is GCC and 56% is your Indian MNCs, large conglomerates, also includes the startups of the world.
How is your business model different? There are so many companies. Like last week we had this week we had SmartWorks listing. WeWork is looking to file its papers. It's got the SEBI nod. How is your business model different? Very quickly.
So basically, we are the integrated workspace solutions company. So when we go to the large enterprises, we do not say, okay, we have about 100 plus centers. Can you come to one of my buildings? Instead, we go with a solution-based approach. We ask them, what is your real estate needs? Where is your talent located? And accordingly, we do the solutions for them. So there are times when they say, okay, we do already have a center, but can you design and build for us, which is our bespoke model? Or can you give us the services, which is our one model?
Provide a lot of value-added services, which is your differentiating factor in terms of a business model, where you provide bespoke services, catering, transportation, whatever the company basically requires. That's about 12.7% of your revenues as of FY25. Does that number go up, and does it command higher margins?
So if we see, again, I will give the historical data that 3 years back, this number was about 9%. And it has been growing because what we have seen the trend is that once a customer comes to us, they like us, they start buying more and more services. A lot of B2B and B2C services is what they add. And that is where if you look at our multi-center client revenue has also grown substantially to about 44% over there.
What does that mean exactly?
It means that typically what happens when a customer comes to us, they take up space in one of the buildings or centers, and once they like, then they expect us to do more. They take more spaces either in our centers, or they expect us to provide services. Or
so 44% of your revenues come from clients who have offices in more than one space with yours.
Multi-center.
Yes.
Multi-center.
Yes, multi-center we call it.
Who are your big investors right now in the company?
So we have one institutional investor, Westbridge, and they have invested 190 crores till date. And the promoters have invested about 125 crores. We have an individual investor, Ashish Gupta, who is on our cap table as well. And total equity raise has been only 325 crores.
Welcome back to Halftime Report on CNBC-TV18. Now, Reliance will be reporting its numbers today. So, later today, now Rima is joining in with us to tell us the key expectations from Jio in Q1 FY26. Rima.
Expect a steady quarter from Reliance Jio this time. The CNBC-TV18 poll throws up a 3% increase in the company's revenues to 30,900 crore rupees. Now, this will be driven by one extra day in Q1 versus Q4, and also an increase in ARPU and subscriber. So ARPU expansion is anticipated to be 1%, while the subscriber increase is anticipated to be about 2%. We'll come to these numbers in greater detail, but these will be the drivers of the top line growth. Margins for Jio have been steady, and this quarter we're anticipating about 53.7%, driving a 5% on an average increase in the company's profitability. But now let's get in a little more detail in terms of the subscriber numbers and the ARPU numbers. Now, the trend that we've seen in the last couple of quarters is that Jio's net additions in subscribers have been greater than that of its closest peer, Airtel. So Jio has been gaining market share. So does that continue even this quarter? The number we're working with for subscribers, 497. For ARPU this time, it's been a steady expansion in the ARPU. Last quarter, it was 206. This time, we're expecting 208, approximately, 208 rupees. And that's because, the last wage hike was about a year back. So the transmission is still taking place, but in a trickle. So the question from here on for Reliance Jio is, when can we see the tariff increase, and can they pick up further pace in terms of subscriber addition to gain some lead over its peer, Bharti Airtel?
Okay, all right, Rima, thanks very much for that. Well, Sonal is now here to decode what to expect from the O2C business at Reliance.
Well, oil to chemicals business for Reliance Industries will be a growth driver. Strong margin expansion is what we're expecting. However, the throughput will be lower because of some maintenance shutdowns. Remember, Singapore GRMs, they are up 81% sequentially, 60% on a YOY basis. And that is the reason the recovery in Singapore GRMs will drive margin improvement for the company this time around. However, throughput, that is expected to be lower, 3% sequentially and 1% on a YOY basis because of maintenance shutdowns that the company took in the month of April. Overall, Jefferies expects the oil to chemicals EBITDA to be up 13% on a YOY basis, however, down 2% on a sequential basis because of that shutdown. But still, it will be a decent number that we'll be watching out for. This is about oil to chemicals. Let's talk about the oil and gas business as well, where EBITDA is expected to fall because of natural decline in the KG-D6 production this time. And that's why Jefferies expects the EBITDA to decline 10% on a YOY basis and 1.2% on a sequential basis. If you look at the trend as well, it has been a continuous increase, but on a sequential basis, this time around, it will be a decline because production volumes, that will come down.
Okay, Sonal, thank you so much for that. But what are we expecting from the retail side of the business of Reliance? We have Mangalam joining in with us to give us those expectations.
For Reliance's retail vertical in the first quarter, the street expectations are fairly simple. Expecting operational improvement and good revenue growth. Put all these together, what is it that the numbers will show up? 16% revenue growth, closer to 88,000 crores on the top line, led by a slightly faster growth in the operational performance, 18% EBITDA growth, 6,700 crores on the EBITDA level as well, which would mean a marginal improvement in the margins from 7.5% to 7.6% itself. Remember, the company has been reporting margins in this band itself for the last few quarters. What is this growth likely to be aided by? One, a favorable base. And secondly, the completion of store expansion rationalization that Reliance has done. So that will further improve operating leverage. And we are expecting around 225 to 250 stores being added quarter on quarter, which is a slower pace than what we've seen in the past. The revenue per square feet, as a result of which, grows between 18 to 20% for Reliance Retail. The other important thing that the street will keep an eye out on, operating leverage and better revenue per square feet, which will lead margins better from here on itself and not just the first quarter. Reliance Consumer Brands, that's something that will be the cynosure of all eyes in this result. Why is that? Because in just its second year of operation, the company has gone ahead and crossed 11,450 crores in revenue. That's the fastest growing FMCG company that we've seen in the country. They've gone on aggressive footprint expansion by Campa, and some of their new verticals are doing extremely well, the likes of Tira, Ustar and Swadesh. So a good quarter all in all expected by Reliance Retail.
Okay, all right. So that's on Reliance Industries. Thanks, guys, for joining in and giving us what we can expect. For the markets, week Nifty down 170 odd points. The mid-cap index also down around 370 odd points. And the Bank Nifty showing a deep cut of around 1%. It's a wrap on Halftime Report. Business Lunch up next.